State-owned sector squeezing market sector. The stock market has plummeted from its historical high of 6,124 points in October 2007 to below 2,700 points on June 20 in just 8 months. It evaporated 16 trillion yuan, equivalent to 200 Vietnamese stock markets, comparable to a magnitude the earthquake. Shareholders wiped out the bull market profits with nearly 90% losing money and nearly 60% losing more than half. In the first half of the year, the fund also suffered a loss of up to 1 trillion yuan, exceeding the total profit of central enterprises in 2007. It can be, he said, that fingers fly and smoke disappear, and there are cries everywhere. While people are still immersed in the bull market frenzy and dreaming of a golden decade, the stock market earthquake mercilessly buries nearly tens of millions of investors at the bottom of the ruins of the stock market. Experts and scholars have been monitoring the pulse of the Chinese stock market for 6 reasons. Firstly, the subprime mortgage crisis, the shock on Wall Street, the Vietnam crisis. 11 became an aftershock to subprime mortgages and the sharp drop in European and American stock markets dragged down the A-share market. 2. The depreciation of the US dollar burns up oil prices. The surge in food prices triggers turbulence. Inflation spreads globally. External factors worsen the domestic situation, kidnap domestic policies and disturb the trend of domestic stock markets. 3. Domestic inflation is difficult to control. Foreign trade is facing a cold wave, and unexpected events such as snowstorms and earthquakes continue to occur. Enterprises are wearing the 7-tide curse, and the situation is uncertain. Drama dismembers market bullish expectations, causing the stock market to fluctuate accordingly. 4. Central enterprises rush to market and go public. Refinancing has constantly exposed the nature of money circling in the stock market. The lifting of untraded shares bans has greatly changed the market supply and demand, causing collective panic selling by institutions, retail investors, funds, etc., leading to a sharp decline in the stock market. 5. There are many drawbacks in the stock market, from fund rat positions to the Wang Yi case, from junk stock speculatio, and to illegal reduction of holdings. Too many dark scenes have become catalysts for stock disasters. 6. The sharp rise of the stock market last year has overdrawn the future rising space, triggering the decline of the stock market this year to squeeze the foam. But upon closer examination, various parties still have their own opinions on the reasons for the stock market crash. Firstly, the sharp decline of domestic stock market is attributed to the subprime mortgage crisis. The collapse of peripheral stock markets and other external factors thought seem to be untenable, because the largest decline in the U.S. stock market Dow Jones index at the epicenter of the subprime mortgage crisis in 8 months is only 18%, while the British stock market Financial Times 100 index, which is more affected by international oil prices China, fell less than 8%.
Not to mention whether the Vietnam crisis is contagious, its equivalent alone cannot shake A-shares. However, China's stock market can plummet by nearly 20% in just 10 days in June, indicating that the big shock in the stock market is not as simple as external drag. Secondly, attributing the stock market shock to systemic loopholes or policy wrong-killing may not seem sufficient, as these persistent stock market symptoms have always existed. Why did the stock market reform in 2006 start a bull market but plummet back before the reform, and still have to pay for the aftermath of the reform? Only institutional policies can explain this clearly. Experts attributed the sharp drop to the reduction of untraded shares and XIOFI, but only 25.47% of the 67.84 billion shares of untraded shares and XIOFI were reduced in the Shanghai Stock Exchange in the past 2 years. The actual cash out was 290 billion yuan, with limited real impact. Why did shareholders panic like frightened birds? The market generally believes that the 10 consecutive negative periods after June 3 were the last straw that crushed the market by raising the reserve requirement ratio by 1%, drawing nearly 420 billion funds in one fell swoop. But this may also be just an excuse for the stock market's decline from gentle to violent. Even though this collapse is a normal foam burst, its speed, depth of decline, and trauma also make people feel different. There's something fishy going on. On the surface, the inducement for this round of stock market shock is the combination of various international and domestic factors mentioned above, but in reality, the real mastermind is there is another person. The original intention of getting rid of difficulties for state-owned enterprises has plagued the stock market for many years by the dominance of one share of state-owned shares. The original meaning of share reform is to get rid of the abnormal capital structure of the stock market. Because the initial cost of state-owned shares is very low, shares outstanding should pay consideration compensation, but the policy of delaying the time of lifting the ban on non-shares outstanding actually shields the long-term disadvantage of the sharp increase of market capacity in the short term, so that the market only sees the short-term benefits of consideration to ignite the bull market. This is the same as the essence of the temptation loan. No interest payment in the first 3 years, and high interest payment in the 4th year, launched by bank credit institutions in the subprime mortgage crisis in the United States. It is just a backward accumulation of risks, which cannot eliminate risks, and the result is a disastrous collapse. Before the share reform in 2005, there were 210 billion shares outstanding and 460 billion non-shares outstanding among the 670 billion A shares, accounting for 31.34%, 68.66%. At present, there are 510 billion shares outstanding in A share market, and more than 200 billion of the newly increased 300 billion shares outstanding are new shares for IPO and refinancing. The rest may be untraded shares converted into shares outstanding in the past 2 years, which shows that the policy delay of lifting the ban is within the controllable range. However, after the share reform, 13 central enterprises such as Bank of China and China Shenhua have listed about 800 billion shares of China Africa shares outstanding, while shares outstanding are only 53 billion shares, accounting for less than 7%. For example, Petrochina's tradable share is only 5%. In this way, more than 800 billion new shares plus more than 400 billion shares before the share reform, the current non-shares outstanding have exceeded 1.2 trillion shares, and the ratio of shares outstanding to non-shares outstanding is significantly less than 30:70. Compared with before the share reform, the proportion of non-shares outstanding has increased rather than decreased. Obviously, the stock reform not only failed to substantively solve the problem of full circulation, but also intensified the embezzlement of market components by state-owned enterprises in the frenzy of central enterprise listing. Now, the promise of share reform must be fulfilled after all, and the lifting of the ban on untraded shares stocks is coming in a rush. Even if simply calculated at an average of 15 yuan per share at present, the market value of untraded shares and XIOFI will also reach 18 trillion yuan, which is equivalent to rebuilding several A-share markets. With such a large sum of funds, the energy of the state-owned economy in the stock market has increased sharply. Even if untraded shares stocks are not released, the market has been intimidated. Once they are released in the future, it will be a flop. Due to the accumulation of too much energy in the state-owned sector, which severely squeezed the market sector, the stock market had to release energy through a sharp drop, and this release of energy is clearly related to conceptual confidence. The listing of more than 800 billion shares of 13 central enterprises has brought into full play the nature of the stock market of circling money for state-owned enterprises. Each of them also stipulates the proportion of non-tradable shares. These non-shares outstanding do not need to pay the consideration before the share reform. Once they are circulated, they are real gold and silver, And that is where the windfall profits lie. Before the stock market, there was expansion and issuance, and after the lifting of the ban on untraded shares stocks, there was no end to bleeding but unwilling to repay shareholders. Insider trading, high-level resignation and cash out and other evil practices were frequently exposed, and shareholders' interests were actually damaged, tearing the bull market mask. When people see clearly behind the bull market, once beautiful concepts become lies, and investors suddenly realize that their confidence collapses. They reluctantly abandon the stock market and make the game of concept relay unsustainable, causing the stock market to naturally shake the ground. Therefore, in the final analysis, this round of stock market shock is the energy release of the state-owned sector squeezing the market sector. Looking back at the compression of the plate, the root cause is that relevant parties have fallen into ideological misunderstandings. One is that they think they will reform the stock market. With just one effort, we can improve the stock market, but in reality, we underestimate the complexity and specificity of the Chinese stock market. The courage of gambling is commendable, but it has also changed the concept of stocks into speculation. In fact, the aggressive competition for customs clearance makes the market hard to bear the capital pressure of non-shares outstanding. Even if the reform design schedules the time for the lifting of the ban on untraded shares stocks, it will also be hard to block the terrorist prospect of future cash. Secondly, it is believed that concentrating efforts to accomplish major tasks is equivalent to the state-owned economy. However, in reality, China's market-oriented approach has already falsified this idea, and it is not feasible for national capital to focus on all aspects. So in order to implement marketization, relevant parties allowed central enterprises to go public, while the integration of state-owned assets through the stock market concealed fake markets and true monopolies. The central enterprises are market-oriented on the surface, but they actually hide huge profits in non-shares outstanding. The state-owned capital, rallying on the natural advantage of power, has an advantage in the game with market capital, which in turn makes the market resources more concentrated in the central enterprises, which obviously backfires. And these self-righteous are all caught by planned thinking, with relevant departments unilaterally using administrative power to lead changes reform, believing that it is controllable, is distorted in the entanglement of interests among various departments. Under the guidance of these ideas, the stock market, which is already plagued with stubborn diseases, is distorted by various forces, causing misalignment and fragmentation at the intersection of forces. With the intense collision of forces, energy accumulates at the misalignment and fragmentation. The energy release of the stock market shock is from the plate impact of the state-owned economy squeezing the market economy, but there are still many fracture zones in the stock market, which may be in the energy accumulation, or may cause aftershocks.